Hello traders, today is the 10th of July 2013 and the time in London is 18:57, in New York 13:57. Happy trading to you all. The title of this video is Wave Trading Education Part 12. If you have not watched Part 1 to Part 11, you may do so before watching this. In this video, we will discuss a specific, a common Elliott wave trading mistakes that traders are making. What we have noticed that traders very often will try to impose a wave pattern on the market without paying attention to the market cycle itself, without paying attention to the cycle point, without paying attention to the S&P 500 itself, which represents the market. And very often traders will get into trouble. Many traders that love to trade the Elliott wave, are looking to forecast the market. There's nothing wrong with forecasting the market, but one should use the forecast as a trading plan instead of just trading, using the forecast as a science, So trader will learn to understand the flat correction, a running flat correction. What is a flat correction? They will learn to master, A, B, C, D, E, chart Elliott wave pattern. They will learn all the Elliott wave pattern, but when they are trading, they do not investigate. They do not do other verification. They do not use the trading triangle, and they get into trouble. Especially some traders that are long-term traders or medium-term traders, swing traders, option traders, future traders. Sometimes they get into trouble because you want to avoid the old-fashioned way of trading. When one see a pattern and just place a trade, you want to investigate. That's very important. Looking at this ExxonMobil, which is a market leader for the Dow 30, ExxonMobil. All right, we can see that I put here the vertical line, 2000, this is a cycle point, 2003 is a cycle point, 2008 is a cycle point, 2009 is a cycle point. We have already discussed that in the wave trading education part 10, all right? But look here, I want you to pay attention to something that has happened here, a common, Elliott wave mistake that traders are making, where I put the green spotlight. You can see that the price was going up for a while, up to 2000. Talking about the cycle point. Even this ExxonMobil went up a bit more, while the market was going up before coming down. All right. So at this point in time, trader will say this is the A corrective wave. So we will say this is the multi-wave, and this is the A corrective wave. Now you can see that the B corrective wave start going up, and it went above the high of the A. The first thing that is coming to our mind is the running flat correction. As we see the price goes above the high of the A corrective wave, as I explained to trader already in one of these series of videos, all right, we will highlight the 138%. Fibonacci extension level. This is the 138%. You can see that as the price was going now, it hit the 138. Traders start selling, which I told you already when we were discussing the ABCD and the wave analysis. Aggressive trader will place orders here, and where the orders are placed, that's where the price will go. So you can see the price went down. We are on a quarterly chart. You see, it went down this quarter and then went back up again to retest it. And then again, it went down. Traders were selling here. Can you see the red candles? All right. Traders were selling here. Why are they selling? Because in theory, when we have a multi-wave and the A corrective wave, and the B corrective wave exceed the A, the target zone that we are watching is 138%, talking about the theory relating to the running flat correction. That's why some traders, some investors decided to divest in this zone, take profit, or some were selling. But as you can see, if you sell and forget, all right, it's not a good idea here because the price continued to move after going horizontal for a while, acknowledging the 138% zone because orders were placed here, talking about a flat correction, using the theory like a sign, this is what we are talking about, without waiting for a clear-cut signal. So the common strategy a trader may use, just draw your trend line or your channel and do your verification, check the balance sheet. Probably at this point, ExxonMobil was very bullish and there was some economy news relating to this. But I don't want to talk about that. I want to talk about the market itself, which is the S&P 500. In the previous video, talking about wave trading education part 10 and part 8, we were talking about the market, which is represented by the S&P 500. We know that the S&P 500 was in a bullish cycle from 2003 to 2008. So by trying to sell this market leader here, is about trading against the market itself. All right, though the prior reach a target zone, yes, the best strategy is to take profit and watch it. All right, wait for it to come out of the channel, retest it, and give you a sell signal. There was none here. In fact, the prior break above it, so you know that there's a continuation. But you have to understand that 2008 is a cycle point. The market was going up while the traders were trying to sell a market leader. They shouldn't be doing that. Well, if one is selling against the market, one must be very careful. So you want to know exactly what you are doing and control the risk. This is a typical wave trading mistake where traders try to impose a pattern on the market, but the strategy has failed because the market itself was in a bullish move from 2003 to 2008. The best approach, whenever one sees a completed wave pattern, one must always check the market itself, which is the S&P 500. It doesn't matter whether you are Indian, in Singapore, in Hong Kong, in Canada, in America, wherever you are, in Africa, in Europe, or it doesn't matter. You want to check the S&P 500 and also check the fundamental relating to the financial instrument that you are trading. The price will not go down if the market is very bullish and people want to buy more. Also, you want to know what we call the core value of the financial instrument. This is a typical wave trading mistake, talking about the flat correction. Traders try to sell here, what they are expecting here is that a big corrective wave will end here, and we may have a kind of move to the downside forming a C corrective wave. But it did not happen here. But it happened here when the S&P 500 itself start going down. You see here, 2008, the S&P 500 start going down. Finally, traders that were selling here were using the theory. They didn't pay attention to anything else. They did not investigate. But finally, in 2008, the market itself reached a peak point. There is a good reason. There was what we call the real estate bubble. Yes, there's a fundamental reason. The market started going down. And look, ExxonMobil also was going down, and went down more. Pay attention. In 2009, the market started going up, but the ExxonMobil continued to move to the downside. The strategy that we discussed already in one of the videos is that one will wait until the price reach a better support level. When we see a financial instrument trending against the market to the downside, we want to highlight the first and nearest support level and watch the reaction and do the verification relating to the fundamental. I hope you have enjoyed this video also about a specific Elliott wave trading mistake that you put into use to avoid this type of mistake. Until the next time, enjoy yourself and be very happy. We are the TSTWSYS008 traders. Speak to you soon.